Assalamu alaikum. Good afternoon, and thank you for attending this session. My name is Hilal Ali Arabi. My name is Hilal Ali Arabi. I am the Investor Relationship Officers, and today with me, our Deputy CEO, Mr. Goba Kumar. Also, I'm joined by our CFO, Mr. Vikesh Mirani, and also our DGM, Maysara Islamic Banking, Mr. Amr Al-Amri. This session is scheduled for 1 hour, and we are going to divide this session into two parts. The first part at the presentation, and the second part for the Q&A. Appreciate to note down your questions for the second part. Now I will hand over the speech to Mr. Vikesh Mirani, our bank CFO.
Thank you, Hilal. Thank you very much, and good afternoon, everyone. Thank you for joining today's call, where we are going to cover the financial statements and financial performance for BankDhofar for the year ended 31st December 2022. The usual slides that I'm going to present, of course, the first slide starting with our disclaimer. We will not be making forward-looking statements and request your consideration for the same. Moving on, my next slide covers the agenda of today's discussion. We will be going through the overview of BankDhofar, looking closely at the operating environment in which we operate in. We will be then looking at the bank's strategy as well as the segmental overview of our bank, going back to the financial performance, looking at some of the key performance indicators and deep diving into the same. And last but not the least, concluding the presentation before we open the same for further questions. Moving on, slide number 4 shows BankDhofar at a glance as at the end of 31st December 2022. Our total income stood at 143 million, which is an increase of 13% year on year. Our net profits 4.17 million, which is an increase of 36% year on year. These figures are in OMR. The net interest, the loans and advances and financing to customers stood at 3.4 billion, deposits at 2.9, and total assets at 4.3 billion as at the end of December. Our margins, which went up almost 51 basis points year on year, stood at 2.5%. Our return on assets at 80 basis points went up by almost 20 basis points year on year. Our return on shareholders' equity went up by 155 basis points year on year and stood at 6.2%. Our return on adjusted equity, which is adjusted for a tier 1 capital, which is 155 million, stood at 4.8%, which is an increase of 123 basis points as compared to the previous year. Our cost to income ratio at 48.7% has seen a sharp decline as compared to the previous year, in which it was 57.2%. ECL coverage, given the ECL that the bank had taken or has taken in the year 2022, reached 101%, an increase of almost 7.7%. Our capital adequacy ratio at 17.6% was way above the regulatory requirement as prescribed by the Central Bank of Oman. We continue to be one of the leading banks in Oman, with the second largest bank in terms of total assets. We are owned by both pension funds and GREs to the extent of 25%. Our market capitalization was upwards of 500 million as at the end of December 22. We have 95% of our workforce being Omanis. 14 nationalities is what represents us in terms of our total staff, and 43% of our employees are women in terms of the gender balance that we closely look at. In terms of the credit rating, we are rated by both Moody's and Fitch. Moody's rates us as Ba3 with a positive outlook, and Fitch at BB minus with a stable outlook. Moving on, the next slide shows the ownership structure as well as the asset composition under various segments that the bank operates in. The top chart shows the ownership structure, which is the 6 large shareholders that we have. Essentially, the bank, as I said, is owned to the extent of 25% by both pension funds as well as GREs, giving us a strong relationship with the government and government-related entities. Our total asset segmental split as at the end of December 2022, as well as the operating income, is shown in the 2 pie charts right at the bottom of the presentation. We are a full-fledged commercial bank providing services across all our segments. The pie charts clearly show a very healthy and balanced spread of both assets and income. The total corporate banking assets stood at 47% of the total assets, retail banking at 25%, treasury and financial institutions at 12%, and Islamic banking at 16%. Likewise, the operating income split is pretty much in line with the asset split, with corporate banking at 46%, retail at 29%, treasury and financial institutions at 9%, and Islamic at 16%. Moving on, slide number shows the bank's journey over the last 33 years and various achievements and significant milestones that the bank has achieved over the last 33 years. We started our operations in the year 1990. We got listed on Muscat Stock Exchange in the year 2002. We started our Islamic banking window in 2013. We became the second largest institution, second largest bank in Oman in terms of total assets in 2014. The bank undertook its transformation journey in starting in 2016. We raised over 300 million Tier 1 bonds in the year 2015, which was repaid in 2022, and then successfully replaced with a local issuance of OMR 115.5 million, which is one of the largest Tier 1 issuance listed on Muscat Stock Exchange. Moving on, some of the key credit strengths that the bank has. We are a leading business in Oman, leading bank in Oman, with the second largest in terms of assets, as I just mentioned. 25% of the bank is owned by pension funds and GREs. We operate from a stable and growing operating environment, which is point number 3 as you go clockwise on this presentation on the slide. We enjoy a solid and robust capitalization. Our capital adequacy ratio, total capital adequacy ratio, was 17.61% as opposed to the regulatory limit of 12.25, and our CET1 at 12.91 as compared to the regulatory limit of 8.25%. We have a diversified and smart distribution channel with over 83 branches, 67 being in conventional and 16 in our Islamic business. We continue to pursue branch expansion as an aggressive part of our strategy, with over 19 branches added over the last 1 year. We have almost 261 machines, which includes 157 ATMs, 78 CCDMs, 22 fully functional machines, as well as 4 multifunctional kiosks. We are supported by an experienced and seasoned management team from multiple geographies as well as financial institutions. Moving on, looking at the operating environment which we operate in, Oman being the second largest country in the GCC, we do enjoy a stable political system. Latest population statistics show the country had a population of 4.98 million. Our real GDP growth is expected to be at 4.1% as projected by IMF, and was estimated to be at 4.4% as at the end of 2022. Looking closer to home, as far as the banking sector is concerned, we have 20 licensed banks in the country, 16 being commercial, two state-owned specialized entities, as well as two full-fledged locally incorporated Islamic banks. The chart that you see on the bottom left shows the total assets, deposits, as well as loans of the entire banking sector. The total assets as at the end of 2022 stood at 39 billion, loans at 29, and deposits at 26 billion. The chart on bottom right shows how the Islamic assets have progressed over the last 5 years. Of course, Islamic Bank has outpaced the growth in conventional at a CAGR of 7.8% over the last 5 years, with 4.4 billion as at the end of 2018 and 6.4 as at the end of 2022. Moving on, this slide shows a quick snapshot of the bank's strategy and the key focus areas. A purpose statement and a purpose being to become the preferred banking partner for all our stakeholders and our customers, which is to be achieved through exceptional service to our customers and providing a delightful delivery experience to our customers. Our strategic pillars, with customer being the center of our strategy, all our policies, processes are drawn keeping that core element in mind. The objective is surely to deliver an exceptional customer service through ease of service, looking at our digital engagement as well as technology, and also timely and efficient services through an efficient performance culture and operational excellence. In terms of our priorities, enhancing digital engagement through omni-channels, we aim to improve and increase our customer stickiness through product penetration, as well as providing a strong value proposition for our customers. We do focus on simplifying our processes to improve our operational efficiencies, leading to an overall improved customer experience, as well as an efficient cost-to-income ratio. Use of data and technology is again one of the key priorities for the bank, essentially to improve our decision-making as well as to improve the customer experience. Robust and disciplined risk management continues to be a key focus area for the bank. And last but not the least, to continue and attract and develop and retain one of the best talents in the banking industry. This slide shows the business segments that we currently operate with. We are a full-fledged commercial bank, as I just mentioned, offering banking services to our retail banking, wholesale banking, government, investment banking, financial institutions, and Islamic banking customers. Our retail bank serves over 307,000 customers, and we, as I said, operate out of 83 branches and 261 ATMs, CCDMs, FFMs, and multifunctional kiosk, offering wide range of retail banking products. Our wholesale business, government and investment business, our wholesale business serves over 23,000 corporate and SME customers as at the end of 31st of December, with industries spread across trading, manufacturing, services, and contracting. Our government business is largely a liability focused business, supporting government and quasi-government institutions, deepening the relationships with those bodies. Investment banking, of course, provides investment banking services both for proprietary as well as for our customers. And we do intend to expand this business through asset management, private banking, and corporate advisory services in the coming quarters. Treasury and financial institutions, apart from managing the funding and liquidity of the bank, also work closely with our customers, providing various foreign exchange, derivative sales, money market products, as well as commodity trading opportunities to our customers. Islamic banking, as I said, which was started in 2013, again supports retail, corporate, treasury, and investment banking customers, providing various Sharia compliant products. The table on the bottom of the slide shows the net profit as well as operating income delivered by all these segments, with retail at 29% of operating income, wholesale, government and investments at 46% of the operating income, treasury and financial institutions at 9%, and Islamic banking at 16%, which is the total contribution to the total operating income of the bank. This slide shows the overall financial performance of the bank as at the end of December 2022. On the top left are the key indicators as far as balance sheet is concerned. Our net loans, which stood at 3.4 billion, increased by almost 3% as compared to the end of December 2021. Our customer deposits during the same period went down by 3%, and I've got some subsequent slides which talks about more details on these performance indicators. Item 2, which is the income statement, shows the operating income going from 126 to 143 million OMR, which is an increase of almost 13%. Our operating expenses during the same period went down from 72 to almost 69.770 million as at the end of 2022, giving us an operating profit of 73 million, which is an increase of 36% as compared to the previous years. Our impairment, which is the ECL charge, the cost of risk went up from 25 to 33 million, which is an increase of 35%, giving us an overall coverage ratio of 101% as at the end of December 2022. Total capital adequacy ratio at 17.6%. I'm referring to the table on the top right. Our CET1 ratio at 12.91%. Our NPLs stood at 5.8%. Return on shareholders' equity, which I talked about, at 6.19%. Return on equity adjusted for Tier 1 at 4.8%. ROA at 78 basis points, and margins at 2.51% during the year 2022. Moving on, this slide shows the bank's journey with regards to total income, operating profits, as well as net profits over the last 12 years. What I'm trying to communicate here is the bank's total income as well as operating profit at 143 million and 73 million is the highest ever in the bank's history. So clearly demonstrating the overall increase in top line as what it was over the last couple of years, where it was largely flattish. So, this was, as I said, the highest in the bank's history over the last 12 years and over the last 33 years of bank's existence. Moving on, the consolidated profit and loss statement, if we look at it at a glance, the net interest income, which was 102 million, which is the top left chart, went up to 122 million as at the end of 22, an increase of 20 million, which is almost 19.5% increase year on year. The total operating income, which is including the fee income, went up from 126 to 143 million, an increase of almost 13%, an increase of almost 16.7 million. The operating expenses during the same period went down from 72.3 million to 69.7 million, which is a reduction of 3.7%, 2.7 million in absolute terms. Operating profit, as a result of increase in total income and reduction in total cost, went up by 36% from 54 to 73 million. Net provisions, which is the ECL, went up from 24 to 33 million, an increase of 35%, giving us a net profit increase of 36% from 25 million last year to 34.17 million OMR as at the end of 2022. I will now request Mr. Amor Al-Amri to quickly take us through the financial key performance indicators for our Islamic Bank business in the year 2022.
Thank you, Vikesh. Good afternoon, everybody. Yes, as we can see here in Maysara, our operating income has been grown by 14.35% by end of year 2022. And from another side, also our operating expense has been reached to 4.6 And this is due to the enhancement of our system and also branches expansion and new recruitment. We are controlling actually our NPAs, and by the end of our profit, by the end of 2022, has reached 7.1 million, which is showing the increase of 22.9% compared to the year of 2021.
Thank you, Amar. As you can see, both the conventional as well as Islamic businesses have improved in terms of profitability, leading to an overall increase of 36% of net profits at a consolidated level. Moving on, I'll now just quickly focus on our deep dive into some of the key line items, both on the balance sheet, credit quality, as well as P&L items. If I look at the gross loans and advances at the consolidated level, it went up from 3.5 billion to almost 3.647 billion as at the end of 22, showing a marginal growth of almost 3%. Of course, we during the year 2022 had some prepayments earlier during the year, which led to this marginal or kept this growth at a marginal level during the year 2022. The focus during the year 2022 was largely to ensure a healthy margin improvement, which is what we could achieve during the year. And I've got a subsequent slide where I'll touch upon the details on that. There were opportunities available in the public sector and GRE space during the year. However, it was a trade-off between profitability as well as balance sheet increase. And as I said, the focus was largely to fix our margins, which was at a level of 2.01% at the start of 2021 and improved to 2.51% as at the end of 2022. The chart shown on the bottom of the slide shows the gross loan composition. Again, the portfolio, as you can see, is well diversified across industries and customer segments as well as products. Moving on, the next slide, which is slide number 20, shows the credit quality at a consolidated level. The chart on the top left shows the non-performing loans as well as the performing loans over the last 4 years. Our NPL stood at 5.87% as at the end of 2022, and the net NPL at 2%, which is net of ECL as well as interest reserves. The non-performing loans coverage ratios, as I talked about, the bank set aside almost 33 million in ECL, net ECL, and 43 million in gross ECL during the year 2022, leading to a coverage ratio of 101% as at the end of 2022. Our stage 2 exposure stood at 776 million as at the end of 2022 as we come out of COVID restructuring. And the stage 2 coverage, which was 4.81% as at the end of 2021, increased to 8.02% as at the end of 2022 with the increase in the ECL that the bank set aside in 2022. Our stage 3 coverage also increased to 66% from almost 54% as at the end of 2019 on account of increased cost of risk as well as the ECL that the bank has set aside. The restructured loans as at the end of 2022, this was again in line with the central bank guidance, and the support that was provided to our customers stood at 570 million as compared to 210 million as at the end of 2021. Moving on the funding and the liquidity side, as I said, which is slide number 21, the customer deposits went down from 2.97 billion to 2.892 billion as at the end of 2022, showing a marginal reduction. The bank during the year 2022 took a conscious decision to let go of high cost and price sensitive deposits. This was again, as I said, consciously done to manage our profitability and interest margins, which was low as compared to our peers, which again now, as I said, stands fixed at 2.5%. This also led to a marginal drop in our CASA to the total deposit ratio, which went down from 49 to 45%. COF, however, stands reduced to almost 3% as at the end of 2022 because of the actions that the bank took to manage its profitability. And at the same time, our liquidity ratios, as far as regulatory liquidity ratios are concerned, were managed well, with both LCR as well as NSFR higher than the regulatory limit at 107% and NSFR at 107.95%. In terms of our profitability and performance, the chart on the top left shows the income streams from various line items on the P&L. The 71% of our income comes from net interest income on the conventional business. 14% of our income comes from net income from Islamic financing. Fees and commission and other income contributed to the extent of 15% of the total income. The non-funded income, which is the chart on the bottom left, shows that the non-funded income went down from 24 million to 20 million as at the end of December 2022. However, if you look at the fees and commission income, which is largely the core part of our business, went up from 16.7 million to 17.5 million. The FX and the investment income went down from 7 to 3 million on account of the reduced investment income, given the volatility that we've seen in the market. Moving on, the operating expenses, as I said, the operating efficiency that the bank could achieve by reducing the cost to income ratio from 57.2% to 48.7%, which is a reduction of over 9% during the last 1 year. This was on account of both increased top line as well as reduced cost, which went down from 72 to 70 million on account of improved operating efficiencies, leading to an overall increase or improvement in our cost to income ratio from 57 to 48% as at the end of 2022. Yield, cost of funds, net interest margins. We have seen over 8 rate hikes over the last 11 months, starting March 2022, which led to an overall increase in the Fed rate by almost 450 basis points. That, of course, contributed to an overall increase in asset yield from 5.14% to 5.54% during the year 2022. Whilst the rates were going up, we could manage to bring down our cost of funds from 3.1% to 3.03%, which again is the lowest in the last 4 years that the bank would achieve on account of some of the conscious calls, as I said, that the bank took to let go of high cost price sensitive deposits. This led to an improved net interest margins, which went up from 2.01% to 2.51%, which is an increase of 50 basis points, giving us a net bottom line impact of almost 20 million in the year 2022. Looking at the capitalization, our capital adequacy ratio as at the end of 2022 stood at 17.6% as compared to the regulatory limit of 12.25%. Our CET1 ratio also was quite healthy at 12.9% as compared to the minimum regulatory requirement of 8.25%. Our RWAs have largely stayed flattish over the last 3 years and stood at almost 4.06 billion as at the end of 2022. The bank is taking significant steps to review its risk-weighted assets and optimize its capital. So there's a detailed review as we speak that is happening or being done both by risk and finance to look at the risk-weighted assets that are assigned to individual exposures that we have. And we are hoping that should lead to an improved capital adequacy ratio, giving us further capital optimization in the coming weeks and months. The dividend history of the bank, which on account of reduced profitability in 2021 at 25 million, stood at 2%, has now increased to 5%, as at the end of 2022 and subject to shareholders' approval at the AGM of the bank. So this is largely what we wanted to cover as part of our performance presentation. Just to conclude, and before we open the call for any further questions, our operating profit, as I mentioned, went up by almost 36%, with both total income as well as operating profits going up to 143 million and 73 million respectively on account of improved margins. Our cost to income ratio declined to 48.7% on account of improved efficiencies as well as the increased top line. Our focus continues to be expanding our geographical footprint, our regional, our domestic footprint. We have added almost 19 branches, low-cost branches, over the last 1 year, and now our branches stand as almost 83 branches spread across the country, with almost 261 ATM CCDM. We continue to focus on our digital expansion strategy as well, with new mobile banking as well as internet banking apps. The liquidity, the bank follows a liquidity-led growth strategy, and that is what is essentially what we are focusing on with the increased customer as well as the footprint that I just referred to. The bank will continue to focus on improving its asset quality and prudent provision management in the coming quarters. Of course, as we come out of our COVID challenges and the restructured loans that we have, we may see some stage 3 exposures going up during the year 2023, which may lead to an increased NPL as well as reduced provisions. However, the aim in the long term is to manage our provision coverage ratio and continue to improve on that, as well as reduce our NPL ratios. Last but not the least, we are supported with an experienced management team and dedicated staff spread across the organization, with 95% womanization, and as I said, with 43% being women staff. I think that's it from a performance presentation perspective. I'll hand it over back to Hilal.
Thank you, Mr. Vikesh. Now I will open the floor for the Q&A session. Kindly raise your hand and appreciate to switch on your camera and introduce yourself. I already.
Good afternoon, everyone. Thank you for your presentation. I just have a few questions. One is that, what is the bank's current strategy for growth, and how has it changed over the past year?
Thank you very much. As far as the strategy for growth is concerned, there are a couple of things that we are looking at. By the way, I didn't get your name. Would you mind introducing yourself?
Yes, my name is Manna. I'm from United Securities.
Thank you. Thank you, Manna. Okay, coming back to your question with regards to the growth strategy for the bank, there are a couple of things that we are looking at, Manna. One, of course, as you would have seen from my presentation, we are looking at expanding our branch network, and this is what we have been focusing on since the start of 2022. We have increased our branch network by almost 19 branches spread across both conventional as well as Mysra. The objective is to increase the footprint of the bank across Oman, and with a clear focus on increasing the customer base. You would have seen the total CASA to the total deposits is around 45%, and which we do understand is lower as compared to our peers. So with the expanding branch network, the various product propositions that we are offering to our customers, we do intend to increase our CASA in the coming quarters, and that essentially should help us drive our growth, on the asset side as well. With regards to the loans and advances, again, during the year 2022, as I mentioned, the plan was, or the objective was, to fix our margins, which is what we did through letting go of high cost, price sensitive deposits. And that's something that we have achieved. Obviously, there were some opportunities available during the year to look at project financing as well as GRE related opportunities. Having said, it was a trade-off between profitability as well as asset growth, and we definitely wanted to fix our margins to start with, which is what we have achieved. So in the coming year 2023, this is clearly an opportunity that now opens up, given we now have a stable and improved set of margins, and something that we will be focusing on. With the improved economic environment, we are also seeing increased opportunities coming in the private sector space, as well as clean and green energy space. And this is something that our businesses are focusing on and expected to grow in the coming 2023. In addition to that, in terms of P&L, if I really look at it, and it's a very broad-based question that you asked, and that's the reason I'm trying to give you a very elaborate answer. As far as fee income is concerned, again, as I mentioned, fee to total income was around 14.5%, as compared to, if I look at my peers, it is quite low. This is again an area that we are closely looking at. This is clearly an opportunity that we will be focusing on in 2023. As far as our existing businesses are concerned, we are looking at it quite closely in terms of any fee leakages, etc., that may exist, and we are trying to obviously manage that well. And you will see that translating into increased fee income starting the first quarter itself. In addition to that, we are also looking at various product penetration and credit card opportunities with our customers, and increasing our product suite, and that should again translate into increased fees. We are also looking at other business opportunities, new business opportunities, which includes asset management, private banking, wealth management, corporate advisory, bank assurance, etc. And that's again, the recruitments, etc., are happening. The infrastructure is being put in place. So fee again is, going to be, from a P&L perspective, clearly, an opportunity that we will be actively focusing on in the year 2023.
Thank you for the elaborate answer. What is the bank's outlook for the interest rates, and how does it plan to position itself accordingly?
Given what's been happening over the last 2 weeks, it's really difficult to really, I wish I had a crystal ball to really see this. Of course, the events that have taken place over the last 2 weeks, we'll have to see how that translates into the interest rate scenario from a Fed perspective, given what's been happening yesterday as well as the week before. Of course, from the way the trajectory that was going, so far there've been, as I said, 8 rate hikes done by Fed, and the OMR rate, essentially the repo rate, mirrors those rate hikes. So we have seen rates going up both on account of increased Fed rates as well as the liquidity situation that we have seen in the local market. Again, we'll have to see with the Fed meeting in March, and we are, as pretty much everybody else, expecting probably a 25 basis points hike. But again, given what's happened yesterday as well as the week before, this is really something that we'll be watching as pretty much everybody else in the industry. In terms of our positioning with regards to how the rate hikes are coming, or the liquidity situation is spanning out to be, we do monitor our liquidity situation quite closely, as well as pricing of both assets and liabilities, pretty much on a weekly basis through various committees that we have formed, which then again translates or feeds back to both the credit committee as well as ALCO. So we work quite closely with Treasury, with businesses to price our assets and liabilities in line with how the market is reacting to the rate hikes as well as the liquidity situation. So yes, given what you've seen over the last 1 year, how we have managed our net interest margins from 2% to 2.5%. This is again something that we very actively look at and manage it, quite closely.
So just to further add to what Mr. Vikesh said, we are expecting that the interest rates will remain elevated or go further as well as we go along, and we are positioning our balance sheet and the liquidity management accordingly. The overriding factor for us is to protect the net interest margin spread that we have attained to whatever extent possible. That's really the focus from our side in managing this.
Yes, Mana?
Thank you.
Are
Thank
there
you
any-
for the answers. That's it from my side. All the best. Thank you.
Are there any questions? Yes, Bishan.
Good afternoon, gentlemen.
Good afternoon, Vishen.
Yeah, good afternoon. Thank you for the presentation. I have to make a comment here. I appreciate the fact that you have mentioned your ROE along with adjusted ROE. Perpetual is a implicit cost which has to be serviced. So we appreciate the fact that you've actually put your adjusted ROE out there. A lot of banks actually just talk about ROE when they have a huge perpetual interest overhang. So we really appreciate that. Given the expansion in NIMs, given your expansion of the retail branch network, your dominating franchise, and sort of being the second largest player, how do you see your ROE and adjusted ROE panning out over the next, let's say, 2 to 4 years? Because I understand the expansion of the capex is not a 1-year plan; it's a long-term strategy. So where do you see ROEs going in the next, let's say, 2 to 3 years? Thank you.
Thank you, Vishen, and appreciate your comment with regards to the ROE on the adjusted ROE. We do take your comments and seriously, and obviously look at it closely. With regards, I mean, it's a brilliant question again. I will obviously shy away from making any forward-looking statements as such. But given the strategy that the bank has deployed, Vishen, net interest margins, as Mr. Gopa just mentioned, is something that we will continue to protect. Obviously, this is coming under pressure given the liquidity situation that we have. Having said, the bank's ALCO as well as Treasury as well as businesses are working, hand in hand and making sure that we protect our margins. Fee income, as I again elaborated as part of Mana's response, is something that the bank will continue to focus on and ensuring that this is something that gets aligned with the market benchmark. Again, we do realize our fee income is low as compared to the market, and clearly the bank is looking at that and driving our strategies towards that. Operating efficiencies again, is very important. You have seen the improved cost to income ratio from 57 to 48%, and the bank will continue to manage this going forward, manage this well going forward. Whilst we are expanding our footprint and adding more branches, and we'll continue to do so in the year 2023. This is again a conscious strategy of increasing our footprint with a very low cost branch expansion network that we are looking at. So this should hopefully translate into improved cost to income ratios in the coming quarters. All this vision in the coming quarters as well as over the next 2-3 years should help us improve our profitability from the existing 34 million. We have a 5-year strategy in place, which the management as well as the bank, the staff are clearly focusing on and getting towards that. So I do expect to increase our return on equity, both adjusted as well as the shareholders' equity, to improve, hoping to improve in the coming year. Of course, we need to be mindful of the ECL as well as the cost of risk, which we do expect to stay elevated at least over the next 6 quarters, which again is going to have an impact on the overall profitability of the bank. And as I also mentioned in my presentation, as we come out of COVID and there will be some restructured accounts or stage 2 accounts which may which may fall into stage 3 requiring additional provisions. Of course, these are good credits and we are monitoring it very closely as part of our credit committees as well as active engagement with the customers. But again, this is something that you cannot really shy away from, which is going to be an industry problem. So this is something that we really have to monitor closely. But again, from a long-term strategy perspective and the 5-year plan that we have, Vishen, we do expect this to the ROEs to improve for shareholders in the coming quarters, and management is very actively working towards that strategy.
The shareholders' equity or the return on shareholders' equity, adjusted equity, is nothing great to write home about. That's the way we view this, especially considering the sovereign bond yields and the other yields on fixed income instruments available today. The objective for us, as Mr. Vikesh mentioned, is to improve that further, and we are targeting to be in double digits. But when that would happen depends on a lot of factors. But from a management initiative or focus point of view, that's really what we're looking at. Thank you.
Noted. Thank you, gentlemen. All the best.
Thank you. Are there any questions? Yes, Joyce. Can start.
Joyce, please go ahead.
Thank you, Vicky. Thank you, gentlemen, for the presentation. Mr. Vikesh, during your presentation, when you were mentioning about this RWA, you casually mentioned about a capital optimization within the coming weeks or months. Can you throw some more color on that, and what do you mean by that?
Sure, Joyce, and thank you for picking that up. It's an important initiative that the bank has undertaken. Obviously, when we look at capital, capital is a function of the total net worth of the bank, or capital adequacy is the function of the total net worth of the bank, as well as the risk-weighted assets that the bank has deployed or lent to our customers. So clearly, we do see an opportunity to optimize our capital by reducing our risk-weighted assets and assigning the appropriate risk weights to the various risks that we have on our balance sheet. So the bank has undertaken an exercise both between risk and finance, where we are reviewing each and every line item on our balance sheet, on our assets side, to look at what should be the right risk weights that needs to be assigned to various risks that we are onboarding. Like, for example, any sovereign risks, etc., should ideally get a low risk weight as compared to any other risks that we take. So there's a clear detailed analysis or review that we are doing as part of improving or rather optimizing our capital adequacy ratio by reducing or managing our RWA in terms of getting the right RWAs for the capital adequacy ratio. So essentially, it's an internal exercise that we are doing without really looking at the net worth, which again stays as what it is, but reducing the RWA by actively assigning the right risk weights. If that answers your question, Joyce. So you will
yes.
see this, as I said, in the coming quarters, getting better.
Okay, thanks. So how much room do you think that we have, for the improvement in our RWA, given other things remaining the constant?
See, again, I will shy away from making any forward-looking statements, but the data review that we are doing, Joyce, should help us improve this at quite a reasonable level. So you will see this coming through in the next, probably in the next few weeks itself. So, there's clearly an opportunity. We are putting in the right effort that is required in this area, because this clearly helps, for us to optimize our capital, at the same time helps, our investors as well as shareholders, from a future years as well as quarters. So you will see good progress over the next weeks and months.
Okay, appreciate that. Another question that I have is on the liquidity side. See, we have increased the number of branches by 30% during the last year. But at the same time, the CASA has declined from by almost 5 percentage points. And we have a very high loan to deposit ratio. So now you have a strategy that you're reducing the demand deposits or the time deposits, and you are trying to increase the CASA. And I understand increasing the regional or the geographical footprint is one of the reason why, which is supporting this strategy. So, what kind of, but at the same time, we are not seeing any tangible improvement in the CASA base mix. So, what are your thoughts, and what are your strategies on this? Are you really looking at a sudden improvement in CASA, or is it going to be a slow process that is coming up? And at the same time, we are seeing the competition also trying for the similar share of the pie. So, what are your thoughts on this?
Thank you for that question, Joyce. Of course, as you rightly pointed out, our CASA vis-a-vis the total deposits declined from 49% to 45% during the year 2022. This was, as I said, was a function of the conscious strategy that the bank had undertaken to let go of any price-sensitive, high cost CASA as well, because CASA does have a cost attached to it. So when we did let go of such deposits, that's also some part of it is also forming part of CASA. As far as our network expansion strategy is concerned, this was something that was agreed with our board earlier during 2022, and the execution was immediately put into place. Of course, there is a time lag between when this strategy is conceptualized and the execution happens. There are various approvals that have to be taken both from the regulator as well as other government bodies. So most of these branches that you see that have come on board or become part of the network has essentially happened pretty much closer to the end of last year, as well as in the first quarter of the first 2 months of 2023. So we are really focusing on actively focusing on improving our CASA through the expanded branch network that we now have, which has only come or become part of our network very lately over the last 3 to 4 months. So whilst it's a gradual process, you cannot really increase it significantly immediately, but we are hoping with the expanded footprint and a reach to the customers, this should start showing good results in the coming quarters. In addition to that, CASA is also a function of product penetration, so to say. So we are expanding our product suite and reaching out to our customers with a larger suite of products. And you would have seen, some announcements coming out from BankDhofar in terms of credit cards, etc. So we are hoping that should also translate into increased CASA as customers start, banking actively with the institution. So clearly, this is something that we are focusing on. And as I mentioned, as part of the increased fee income drive that the bank is having, there are new business opportunities that the bank is looking at, which includes asset management, private banking, wealth management. We are hopeful it should not only contribute to the increase in fee income, but also lead to an increase in CASA balances as more and more customers start actively, banking with our institution. So to answer your question, yes, this will take time, but clearly this is an opportunity given the market is at a different percentage, and there's only an upside that we are looking at. We are also working very closely with some GREs and government-related institutions, because there's an element of sticky CASA that can be explored in that space as well. We do enjoy good relationships with sovereigns as well as GREs by virtue of they being our shareholders, and this is something that again is being actively considered as part of our overall strategy. With regards to loans to deposit ratio, you're right, it is at 118%. And again, given some of the conscious calls that the bank had taken, the objective is to improve on this in the coming quarters. Having said, we actively monitor our regulatory liquidity ratios, which includes both LCR as well as NSFR, which I briefly mentioned in my presentation, are reasonably higher as compared to the regulatory limit of at 107 and 108% respectively.
Got it, Vicky. And how is our geographical expansion, the branch expansion, going to impact the cost to income ratio? Do you see a slight increase in the cost to income ratio, or are there any efforts now to ring fence any additional expenses coming into getting filtered into the cost to income ratio?
Our objective for this year is to reduce the cost income ratio.
Okay. So where do you see where do we see the room for further reduction in cost to income ratio? The reason why I'm asking is we have added 20 branches during last 12 months, and probably we'll be adding new branches. So won't this be bringing in new additional cost to the bank?
Yeah, it's both, right? Cost to income ratio is a factor of both increasing your income and managing your costs. So on both sides, we are working on that, and that should result in hopefully on a lower cost to income ratio going forward.
I think the objective clearly, as Joyce, as I mentioned, and further to add to what Mr. Gopa mentioned, we are looking at a low cost branch expansion model. So the plan is to manage our costs well in the coming year. Of course, we would probably see a marginal increase in the cost, but again, it's a function of both top line as well as cost.
Sorry, Vikesh. No, I think if you see historically, the bank's cost to income ratio has been pretty high. It has nothing to do with the branch expansion. So we are cutting through a lot of costs on various aspects. So while we do expansion, we'll be optimizing on costs at various fronts. Yeah. Thank you.
Thank you very much. That's very helpful, and I wish you all the best.
Thank you, Joyce.
Thank you, Joyce.
Yes, Vishan.
Vishan, I see your hand raised.
No, I think he didn't close it. We didn't close it after you.
Are there any questions, guys? Since there are no any further questions, I will have to pass it back on the CFO for concluding the remarks.
Thank you, Hilal. Thank you, everybody, for joining today's call. And as I mentioned, we have seen good progress in the year 2022. Clearly, looking at some of the key performance indicators, both on the balance sheet as well as on the P&L side. From a strategy perspective, as I mentioned, the bank has drawn a 5-year plan and a strategy, and everybody in the organization is focused on delivering on that. Ultimately, the objective is to improve on our return to our investors as well as shareholders and improve our performance. So we will be focusing on that, and you will see more updates coming from the bank in the coming quarters. And thank you very much for participating in today's call. Thank you.
Thank you very much, everybody, for coming in, and hopefully We believe in true engagement with the investing community in terms of and being transparent in terms of what happens at the bank. And I know from the investor relations team, Hilal and Mr. Vikesh are engaging with the analysts and any fund managers who are interested in knowing more. And I think we'll continue with the conversations. Thank you very much.
Thank you.